Do you have to be in default to qualify for a negative short sale equity? Do you have to have negative cash flow to be? Do you have to have a financial hardship in order to qualify for one of those? What are the, and then what determines, or obviously like what determines whether or not somebody actually gets approved for a short sale or doesn't? Like, meaning, is it like if I'm losing, like if my mortgage is 3,000 and I'm losing $100 a month, does that qualify? Or like,
So I don't know how to answer your question the best. It depends on the file and depends on the property and the borrower.
hi everybody, Jose Luis Morales here. Welcome back to another episode of the Morales Group Show. Today we have a very special guest. The name is Paul Stansen with Paul E. Stansen, a professional corporation. He is an attorney slash real estate broker, and I am excited because today we're going to be talking about what is a short sale. We're going to be talking about how does a short sale work, who qualifies for a short sale, what is the short sale process, and just different things associated with short sales. Welcome to the show, Paul. How are you?
I'm doing well. Thank you very much for having me. Appreciate the opportunity.
Same here. So for our viewers that don't know who you are, who is Paul Stansen? And then how did you get involved with short sales?
So back in the 80s, a long time ago, I went to law school at Pepperdine University and decided to stay out here. But I am a licensed attorney and broker in Colorado and California. How did I get involved? And I've only been in real estate my entire life. I'm not a litigating attorney. I'm a real estate guy and a
I
broker.
love it.
And so I think it was back in 2008, the time came when it was obvious that there was going to be an upheaval in the residential real estate marketplace, carried forward into the commercial. And I just switched business models and became a resource to other brokers, primarily in Ventura and in Santa Barbara counties. And I proceeded at that point to handle, at that time, at those values, about $350 million worth of short sales. And they were all negative equity short sales. So I was just a resource to all of them, and provided legal, tax, and real estate advice to the homeowners as well as some of the brokers.
I love it. So for our viewers that don't know what a short sale is, I know you said negative equity short sale. So let's just start off there. What is a short sale?
So a short sale is a situation that arises where there is some kind of financial distress with a homeowner, with a mortgage holder, and they need some type of mitigation that comes only from the lender. And that can happen in two different ways. One is where somebody wants to keep and stay in the property. That would most typically manifest itself in a modification, or they need to get away from the property, which is typically a short sale, where the lender has to agree to accept less money than what is owed on the mortgage. And it always arises as a result of negative cash flow. In other words, the homeowner just doesn't have enough money to pay all of the ongoing living expenses and the debt of one or more mortgages.
Got it. So basically, it's a situation where the homeowner owes more than what the home is worth, but not everybody that owes more than what the home is worth sounds like would qualify for a short sale.
That's true. And incidentally, or to punctuate this, back in 2008, 9, 10, 11, and 12, those were negative equity short sales where the property was worth less than the mortgage. Today, what we're starting to see happen are positive equity. They're not short sales, but they are distress sales. So you refer to them as short sales, but whenever there's some kind of a life event, it could be a divorce, it could be a financial situation relating to the individual's work, something, or somebody dies for that matter, that requires an interaction with the lender on title. And that could be whether it's a traditional conventional mortgage, or for that matter, what I'm starting to see more of these days, and I got a call just a couple of days ago in a situation where there was a reverse mortgage. So even reverse mortgages can give rise to a foreclosure where the lender is saying, hey, you're not servicing the debt. We want the property back if you're not going to pay us. And so they put pressure on the homeowner. That requires interaction with brokers, as we both are, and or somebody like me that focuses on working with the bank to get either a loan modification or some kind of a situation to allow the property to sell.
Got it. So for the purpose of this video, I think what we're going to do is we're going to focus more on negative equity short sales, meaning just people that owe more than what the property is worth. All the other ones are basically they're in distress, but they can sell the property because they don't need a lender approval to be able to sell the property, right?
Yes and no. Yes and
Okay.
no. There can be a situation where once you value the property, and let's say that a notice of default, which is the precursor to a foreclosure, it's
Hmm.
telling the individual homeowner, hey, you have defaulted. You may be 30, 60, 90 days behind on the mortgage payment. Uh, and depending on the valuation of the property, it may end up actually being a situation where there needs to be interaction with the lender, because we both know, looking at a closing statement, that there's a gross sales price and then there's the net proceeds.
Yeah.
So that analysis has to be done in order to assess whether it's a negative or positive equity sale that requires potential lender intervention. And you won't know that until a request is made of the lender for a demand payoff statement
Got it.
and the property is valued.
Got it. So who would qualify for a negative equity short sale? Meaning like do you have to be in default to qualify for a negative short sale equity? Do you have to have negative cash flow to be? Do you have to have a financial hardship in order to qualify for one of those? What are the qualifications to be able to qualify? And do those qualifications vary lender by lender as well too?
Um, Last question first. Yes, it varies from servicer to servicer, because typically, if a loan's been in place for a period of time, it is entirely probable that the loan has moved from the lender's portfolio to a servicing agency who acts really on behalf of whoever the investor is. And you never know that till you start talking to the lender or the people I'm used to speaking with, who are the loss mitigation people. And so, what qualifies as a short sale is really the precursor. All pivots back to financial distress. There has to be some sort of a explainable cash flow financial distress situation. Otherwise, it just looks like somebody's trying to get away from the property and from the debt. And lenders don't look fondly on those types of what I call strategic short sales. So, a precursor is filling out applications that explain to the lender, to loss mitigation, what the particular financial distress is. And it can't be something manufactured or pretend, because ultimately, loss mitigation, or the lender or the servicer, is going to look at bank statements. They're going to look at a personal financial statement. They're going to put a stress test on the mortgage, the borrower, to be able to determine whether or not intervention is required. And this isn't something that you throw something against the wall just to see if the lender or the servicer is going to accept. It's something that has to be done in good faith, transparently, and in earnest to capture their attention.
I love it. What would be the benefit to the homeowner of doing a short sale versus just letting it go to foreclosure or just giving the deed back to the bank?
So that last one that you're referring to is a deed in lieu of
Yeah.
foreclosure. or you just hand the keys back. The
Yeah.
upside benefit is really having more control over the outcome. In other words, a
Mm.
lender doesn't, or a servicer doesn't really care what the property sells for, so long as it exceeds whatever is owed. And you'll remember that I talked about a demand payoff statement earlier. So the lender knows how much is actually owed on the property, which is typically, let me rephrase that, it's always different than what a mortgage statement says that you get on a monthly basis. It's typically more than that.
Mhm.
And complicating it a bit, it depends on whether or not the loan has an impound for taxes and insurance. So that's a, I don't know how much you want me to get into the details of that, but it becomes a more detailed analysis to determine what is actually owed. So, who would qualify? Again, it has to be somebody with a true financial distress situation.
Got it. So, but for a negative short sale situation, is it beneficial when you say more control of the outcome? Is it more beneficial for somebody to let the property go into foreclosure, do a deed in lieu of foreclosure, or is a short sale more beneficial, or does it depend kind of just case by case?
It is a circumstance related type scenario. There are tax and legal implications on whether or not one would want the property to go to foreclosure or to a short sale. For instance, if there are one or more loans, two or more loans, I should say, on a property, it depends on who's seeking to foreclose. If it's the subordinate lien holder, for instance, a line of credit or an equity line, um, that would you would not want that to go to foreclosure because the how can I put this where it doesn't get too complicated? There's a promissory note, there's a contract. And if the borrower, the homeowner, has signed a contract with both, which they would, obviously, with both the primary lender and uh, the subordinate lien holder, then that uh, lien, excuse me, the contract and the obligation to continue paying for that subordinate lien continues after, for instance, the primary lender forecloses. So just because the property forecloses doesn't vitiate or eliminate the borrower owing on the junior lien or lien, plural liens. So it really comes down to who is the borrower, the homeowner defaulted on, what is actually owed, um, how far along in the foreclosure process are they? Is there enough time to sell the property? What is the value of the property? A lot of things need to come together. Those stars need to come in alignment to determine strategically who is going to be affected the most. Beyond the um, another reason to consider whether or not foreclosure is a good or a bad idea is something called forgiveness of debt. So anytime there is a any creditor, whether it's a secured creditor like a bank on a mortgage, a loan on a home, or it's just a credit card, if they walk away from debt that's owed, that's taxable income. And they send to the IRS and the state franchise tax board a, a deficiency judgment or a deficiency notice, and that becomes taxable, and you have to report it and you can't ignore it. So the question that you're asking is really back to whenever I spoke to my clients, do you want to be in control of your destiny or future, or do you want the bank to do it because they don't care? They're going to be made whole probably in any event. especially in today's marketplace where there's been such a run up of appreciation on property. So just because it's a positive equity distress sale doesn't mean that a broker would want to not make sure that all of the lenders were involved, or at least that the broker knew, as well as the homeowner knew, what is actually owed on all of the loans, and then compare and contrast that against the value of the property, which you and I both know as brokers changes if it's a 30-day sale or a 90-day sale. You might be able to wait out time to be able to get more for the property than a quick sale.
Yeah, so I think for once again for I think for this one, I think as long as the equity sale ones, I mean, obviously we can get the payoffs from the lender, we can get title reports to see what is owed, and escrow can provide a seller net sheet to let us know what the actual amount would be on it. I was looking for more of the tax and legal consequences of foreclosure versus deed in lieu versus on a short sale. Like if in all cases a short sale is better, because as agents, most agents will tell you, oh, do a short sale versus in this case, it may not be better for you for this or that reason. So I guess my next question is, and when I say short sale, I'm referring to negative equity short sale, meaning like it's a
Right.
short payoff, in other words, meaning that the bank is taking a loss on the property. So if the bank takes a loss from what is owed to what you sell the property for, do you still owe that money in a short sale?
Depends on whether or not, and that's a legal question. It depends on whether that was the original loan when the property was acquired
Mm-hmm.
or it was a refinance. If it was a refinance, um, and there's some assumptions in the question that you're asking, and I presume I am to assume that there is not a subordinate lien, and we're only dealing with one primary
One,
loan.
correct.
Okay, in that type of a situation, there is no legal recourse in California, and we're only talking about California properties here. So if, and I could address it if it was Colorado, where the answer would be entirely different. But in California, there is a provision within the deed of trust and the promissory note that the source of recovery is entirely within the realm of
The
the
property.
property itself. Correct. So if there is no subordinate lien and we only have the one loan there, then there's no legal recourse to the lender. However, if there's a deficiency that the lender realizes, that is taxable because it's forgiveness of
Income.
debt.
So it's
Correct.
basically taxable income. So you'll be receiving like a not a 1099 or at the end of the year, basically like a
Yeah.
1099 form saying, "Hey, look, you made $100,000," and then you have to deal with it at that point, basically. So you
Right.
have to pay
And
taxes on that amount.
as if it's ordinary income, as if you made W 2 wages at work. All of a sudden, now you have this extra income. You can't ignore it. And by the way, if they don't send you, if the servicer or the lender doesn't send you one, you can't say, hey, I never received it, but on the low, you just set it to the side or under papers and pretended like you never got it. Doesn't matter. You know what happened during the course of the prior year, the taxable year. You had to step away from the property, and whether it was a foreclosure or uh, uh, a short sale, that you're gonna get taxed on any deficiency.
Was there a period of time where that you did not get taxed on that deficiency? Like, was there a period of time where the government had some sort of special clause that made it incentivize people to do short sales?
Well, that's that's kind of a so yes, lenders are not in the business to take back property, so they provide incentive. And that may be cash for keys, or which is, by the way, it's supposed to be taxable when you get tax. cash for keys because that's just out of the blue. But was there a point in time when lenders would say that they would step away from and not 1099 you for that deficiency? I think it's up to because I've seen it happen both ways, where the lenders did not file any kind of paperwork, although they could have, should have. And so those clients of mine were able to avoid paying any tax on the deficiency. And that's in recent time, meaning the debacle in 2008, 2009 forward.
Yeah.
But anytime there's a deficiency exceeding $600, it's supposed to be 1099 and it's income that is reportable, and tax has to be paid on that.
And this is non-negotiable. This is not something like on the short sale part of the agreement where somebody like you can negotiate, hey, look, this is not going to be one of those situations where I receive a 1099. That's not a negotiable item, I'm guessing.
I would generally agree with that comment. That said, I've negotiated with and indicated to lenders that we didn't want to receive a 1099. I did one like that in Hawaii. Remember here back when there was, I don't know whether that one was, it was a volcano. I remember that one. The volcano came down and burned the entire community, and my client had a Airbnb type home. It was burned to the ground. And they said, well, we need to be paid in full and we want to go out and appraise the property. And I said, are you aware of your inventory and this property? I mean, you can just kind of look up the volcano burn area and the property address. There's nothing in there. You can't even walk in there. Well, we need an appraisal. Okay, there's lava there. So, but we did negotiate away, and that was a full recourse type situation. And insurance did not cover. So they wanted whatever insurance would cover. And they said that they would not send a 1099, and my client never got one. And that was probably 8 years ago, something like
so
that.
there is a way to be able. So, and the reason I was asking that question is that I think whenever people are doing a short sale, whoever negotiates the short sale for you plays a big impact, because if you're negotiating the short sale yourself, or you're getting somebody that doesn't really have experience in negotiating short sales, you could be missing certain things like, oh, great, we got the short sale. Then a year later, you receive a 1099 because that wasn't negotiated in there, or you weren't made aware of that. Now you owe a tax bill for $100,000 or $30,000, whatever it may be. So I think that that's important. Let's go back to your example of.
Let me just add to that whenever anybody, whether it's the borrower, the broker, or somebody like me, deals with loss mitigation, whatever you're told over the phone means nothing.
Nothing. Yeah.
You need it in writing. You literally need it in writing. And adding other layers of complexity, because that was the world in which I live, there might be tax liens, and you have to get those tax liens off of there. The IRS, the Franchise Tax Board, are kind of reluctant to do that. And they also have priority. So it gets very complicated. So you need a really transparent understanding of the property, especially the borrower, in which case I always do a background check, and I compare that against a personal financial statement so that I have an understanding as best as I can about the property and the client, because clients sometimes tend to tell you what you want to hear or what they think they feel like sharing with you. And
versus the whole story.
The whole story. And so that can catch you flat-footed when you're dealing with loss mitigation. So it's much more complex a lot of times than you would think. And you may look at a file. As brokers, we look at files and think, oh, this is going to be a straightforward straightforward sale, and then it turns into a mess. Ever
Yeah.
have one of those?
Oh yeah, and I think what you're saying is I think important because sometimes things, even for a lot of lenders, things will pop up that the buyer didn't disclose or didn't feel that they would eventually find out, and they do. And there's nothing worse than being caught off guard because you've planned for this scenario, and now all of a sudden this thing that wasn't disclosed to you changes everything. What I wanted to ask you was, originally we were talking about doing a short payoff, meaning a negative short sale situation. You talked about if it was an original loan, a refinance, or a subordinate lien. I know that we
Correct.
talked about the original loan. We didn't really talk about the difference on a refinance. Like, what difference does it make if it's a refinance, and what difference does it make if it's a subordinate lien as well too?
On the subordinate lien, that's entirely subject to exposure in terms of legal and tax liability. So if the primary lender is the one foreclosing, that just wipes out from title, only from title, not the debt, that subordinate lien. The obligation, which arises because of the promissory note, continues. And so the lender in that case on the subordinate lien would seek to recover whatever is owed. And they might even try and sue the homeowner, or they might just throw their hands up and say, well, in good faith, we tried. And they do need to try in good faith to collect. It might be a letter, might be a lawsuit. And if they are unable to collect, then the backup position is the 1099, and you get taxed, and they get a write-off.
Got
Um,
it.
on the refinance, there are different nuances of how those loans are handled in terms of whether or not they're recourse or not. It's where it is the primary loan acquired during acquisition that makes it a non where there's a non-deficiency situation where they cannot come to collect on any type of deficiency. And the law has been somewhat changing in terms of how the courts look at that continuing obligation. They also look at how much is owed. And one of the things that we haven't talked about, but something that I always try and collect, that thick packet of documents that we get when we buy a property or we
Yeah.
refinance, and
Hmm.
typically nobody reads them.
No. Yeah.
Except me. And you see all of that minutia language in there. One of the documents that is included is a loan application, and there's in every deed of trust in California a provision that says if you misrepresented any aspect of what you input onto that application, um, everything is recourse, whatever the deficiency is, whether it's on the primary loan or a subordinate loan, they can come after you. So for me, as an attorney, because I'm wearing the two hats of broker and attorney, I always ask for that loan application just to see what it is. And a lot of times when I would talk to loss mitigation, they would bring up the application and they would say, borrower said that they made $240,000 a year. We think that that's not true. And they'll ask for the tax return in the year that the loan, and maybe even the previous tax return in the year the property was acquired or there's a refinance. And
Hmm.
if there's a deviation between the two, that's an uh-oh moment. And I've seen that happen. That's another flat-footed moment. So to the extent that you get all of the documentation up front, and most people keep that stuff, they've thrown it to the side. They didn't read it the first time. They haven't read it since, but for some reason they kept the documentation. I receive all of that. I scan it, OCR it. I go looking for the documents that I want, primarily that application. And I just ask the client, did you sign this? Is the information true and accurate as of the date the loan was acquired or on the refinance? And if they say, well, it's better to know that up front than it is,
Yeah,
changing the strategy.
got it. Okay, so if it's a refinance, then it's recourse for the deficiency as well, too, basically, even
It
if
can,
it's on the original loan, basically.
it can be, yes.
You meaning like, does it make a difference if it's a cash out refinance or a rate and term refinance? Does that make a difference?
It really doesn't matter whether it is either or.
Just as long as you refinance, basically. Got it. Okay. Now, the other thing that I got from this, and I remember telling clients is a lot of people assume that all short sales are the same, or all negative equity short sales are the same. The reality, and this is based on our conversation, every negative short sale equity is different. It's going to depend on how who the servicer is. It's going to depend on who if it has tax liens, if it has IRS liens, if it has judgments, if it has child support, if it has a first, if it has a second, if it's a refinance, if it's a subordinate lien. All those are different factors that affect the short sale. So in other words, um, a short sale is going to vary just based on different situations. If you're a buyer looking to buy a short sale, there's going to be some short sales where you may not want to get involved because the chances of them closing are slim to none. It may even be that they don't have a good short sale negotiator that doesn't know how to prevent some of the problems before they happen. And there may be some short sales that are slam dunk. So, as an agent or as a broker, if you have a client looking at a short sale, it's more or less like finding out who the liens are with, who the servicer is, what are the different types of loans. Those are all important to be able to determine whether this is a short sale that you want to get involved in. Um, what does the short sale application process look like? Like meaning like what's included in that package? What are some mistakes that you see in this package, and what are some maybe pro tips that you'd recommend as well too um, in the short sale package?
Yeah, my encouragement to all brokers and to borrowers, homeowners, is that they gather together as much information as they possibly can when the problem, the financial distress, arises. And when it comes to brokers, I'm going to bifurcate this next comment between brokers and homeowners. Brokers we need to understand that if we don't have a license to practice law, we best not, in my opinion, no matter what you do as a broker, as an agent, the questions being asked in this sort of a scenario necessarily lean toward providing legal and tax advice, which you're not licensed to do. So if you are concerned about liability exposure, that's just something you don't want to do. You want to blend with somebody like me, collaborate with somebody like me uh, out there because I'm licensed to do that. Um, and there's a lot of exposure with the Department of Real Estate and with actually the state Bar of California and the Attorney General's office. It becomes a felony, actually, to give legal advice when you're not licensed to do that. That's the consumer protection aspect of being licensed. When you're a homeowner, you want to make absolutely sure that whatever information you want to separate the emotional side of, oh, gee, I might lose my home, to the information gathering process. And by that, from my perspective and my experience, it is bringing all of the documents that you possibly have, any communications with the servicer, the lender, to somebody like me, so that that documentation can be looked at carefully because it will establish a timeline. And there's only a finite at 111 days from recordation of a notice of default to foreclosure. Typically, it will go a little bit longer just because of weekends, holidays, that sort of thing. And generally speaking, back in the day when there were a lot of short sales, lenders just couldn't get to all of them. Today, they can, and they do, and they will, because they have REO programs set up to flip that property and get rid of it. There is certain documentation that I have that allows me to speak on behalf of homeowner, a borrower. It's called a third party
Authorization.
authorization, right? It's the only way that I can start asking questions. And the dynamics change completely when somebody like me calls loss mitigation and says, "Hi, I'm Paul Stansen. I'm an attorney broker." That's two things that the loss mitigator hears. Uh-oh, it's an attorney. So, I need to pay attention to what's being asked and said. And number two, he's a broker, so he understands real estate from the inside out. And that's true in my case. Um, and as all of that information is looked at and gathered, it may lead somebody like me into asking for additional supporting information, tax returns, bank statements, just a myriad of things that help to establish why there's financial distress to begin with. What is the cash flow problem that would justify a lender getting involved? And to be clear, uh, lenders are not required to participate in any kind of intervention. They're just not. They can do so at their discretion. So if somebody says, I want to keep the property, I want to do a loan modification, well, okay, best of luck. But generally speaking, if you've already defaulted, you've already established, if you've defaulted on the loan, you've already established a likelihood that you can't perform in the future. But a lot of clients that I came across wanted to go down that loan modification analysis and discussion with the lender. And sure, that's fine. I'll do something like that unless it becomes very obvious that, look, you lost your job or there's a divorce, there's just not enough money on a monthly basis to service living expenses and debt. Um, but when it comes down to documentation, to answer your question, from a borrower, I just need that thick packet of uh, documents when the loan was originated, whether by acquisition or refinance. And that heads me in the right direction to set a strategy and a timeline. Timeline is crucial, which is why it's so vitally important. If there is any takeaway from this conversation to brokers and borrowers, homeowners, everybody concerned, the sooner you act, the more time you have to put together a meaningful, successful strategy that will protect you from legal or tax liability.
Got it. Do different lenders have different application processes for short sales?
They have different applications, but the process is, from my experience, pretty much the same. They just want to know whether or not there's enough money to service the debt. If yes, okay, then maybe. And sometimes what I would tell my clients is, just because you want a modification, just because you really want to stay in the property, doesn't mean that that's the best legal or tax end result. It might be better for you to step away from the property by sale or deed in lieu of foreclosure, believe it or not. And the benefit, I don't think I commented on that before. If a person is really in financial distress, they might be a candidate for bankruptcy, Chapter 11, reorganization, or Chapter 7, complete uh, extinguishment of all loans or all debts out there.
Mm-hmm.
So when I get the thick packet, and you can see how this all becomes circular, once I have that thick packet of documents and I've seen the application and I understand who the borrower is and what the property is worth and what its physical condition is, that matters to you and me as brokers on what we might be able to generate for the property. 30 days, 60 days. Does the owner have money to put into the property? All of those things combine to help make a decision. And when I negotiate with loss mitigators, I'm very candid about that. Because all the loss mitigation companies do is they go to Zillow or to realtor.com or to Redfin, and they think that they know the value of the property, or even they send somebody to do a drive-by. Well, drive-by doesn't tell you what the condition of the property is on the inside. Is it great, just recently renovated, or is it run down? All of those impact the decision to try the mod, do the deed in lieu, or to avoid a foreclosure, do a short sale.
Got it. What does a short sale package actually look like? Like, okay, so probably a hardship letter in there, the lender application. They're probably going to want a certain amount of bank statements. They're probably going to want pay stubs. Anything else that they would want in a short sale package?
Tax returns.
Tax returns? Anything else?
Tax returns. Um, no, I mean, you just hit on all of the primary things that are going to be needed. And it may vary, believe it or not, from whether it's a regular type of loan, a standard loan, or a jumbo loan, because there's more money exposure there. So the lenders want to see more about the individual and what gave rise to the request for intervention.
Got it. Okay. And then what determines, or obviously like what determines whether or not somebody actually gets approved for a short sale or doesn't? Like, meaning, is it like if I'm losing, like if my mortgage is 3,000 and I'm losing $100 a month, does that qualify? Or like what's like the determining factor or the determining factors?
None of us know. None of us. And just to be really honest, not always does all I have found is that out of the hundreds, thousands that I've actually done, the more organized I was in my submittals, the quicker and more likely I was to get approval. And there are different levels of organization that you might do, that I might do. Mine are really detailed, but condensed. And they just tell a story because these people do not want to sit on the file. And so if it's a deficiency, a short sale where the lender is only losing 3,000, in your example, yeah, sure, they're going to approve that pretty quick
Got it.
because they're not going to spend the time on it.
Does a short sale affect somebody's credit?
Always.
How so?
Well, it's going to show just as same as not paying on a credit card or on a car loan. It's going to show as a default on a debt. And so the fact that it's a huge ticket item in all of our lives, it's going to impact significantly, and it's going to sit there for some period of time.
Yeah. What about like if the property's in foreclosure and it's like a week before the foreclosure date at the notice of trustee? Is that too late to start a short sale, or can you still start a short sale? And can a short sale actually postpone the foreclosure process?
Anything's possible, but generally speaking, if anybody came to me after a notice of trustee sale had been recorded, sent a message to me that they weren't really serious about keeping their property and they were just playing games with the lender. So I generally steer clear, and most attorneys, most people that do this line of work would steer clear. But to your point, will a lender, a servicer postpone a trustee sale? Maybe. It's the
Got it.
best answer I can give you. Maybe. Depends on how
What
much is at risk. Is there an offer on the property? Have you submitted it as part of the loss mitigation package, et cetera, et cetera? It all
what about
depends.
what about like default? Like, do you have to be in default to get approved for a short sale, or can you be current and still get approved? Like saying, "Hey, look, I'm barely squeezing by. Like in a month, I'm gonna lose my job. Like I'm not gonna be able to make the payment. I want to
Right.
do the short sale."
So it depends on the servicer or the lender, or in my case, the rapport I had with a number of loss mitigators who would know me, or I would tell them, "Hey, I worked with Cheryl, and oh yeah, she's sitting in the cubicle next to me. We'll talk to her about Paul Stansen," and they would, and find out whether or not it mattered that there was nothing yet defaulted. Generally speaking, there's no reason, there's no trigger to cause them to get involved until there's a default. So technically speaking, yes, you have to be in default.
Basically, I've heard this, and they've said that they don't really pay attention to you unless you're in default, which is kind of like almost like, uh,
Yeah.
yeah,
So you would think that they would want to work with somebody and get ahead of, but they just
the
don't
default.
care.
Yeah.
Right.
What about like how long, like from the time you get the client to the time the short sale closes? What is that process like? How long does that typically take?
I mean, it really depends on how far they are into the default, whether or not the foreclosure has been started. I've had uh, especially great luck, fortune of getting credit union approval on short sales in as short as a day. No kidding, just a day. With other Wells Fargo, they would, generally speaking, get to my files very fast because most files are unorganized. They would see my file and it was all bookmarked, and everything is electronically submitted. So I don't know how to answer your question the best. It depends on the file and depends on the property and the borrower. It can take from 1 day to 111 days. I told you that was the timeline for a notice of default and a notice of trustee sale. And then add to that probably 30 days or 40 days for the escrow, right?
Hmm.
So once you get approval, add another 30 to 40 days to be able to close escrow.
What's included in that approval letter, and what happens if you miss the deadline on that approval letter? Like saying, "Oh, like this short sale is approved until February 15th." What happens if you're unable to close by that February 15th timeline? And what are some of the things that are outlined in that approval letter? And what are some of the things that you need to include in that approval letter?
Well, the approval letter that comes from every servicer is, generally speaking, boilerplate,
Okay.
and you don't get to change anything on it. And it's primarily oriented to ensure that whatever agreement there is from the lender to accept a certain dollar amount, that is really based on their review and approval of a closing statement that shows the net proceeds. For instance, they are not going to approve from the proceeds paying off your American Express card, right? And I've seen people say, well, yeah, I'd like to get all of these other charges or these other debts that I have paid off. No, it doesn't work. It doesn't work that way.
That's fine.
Um, so if you miss the 15th of February, you snooze, you lose. You have to go back and beg, but you would have to beg to, and you may have to start a brand new process because that approval letter is property specific, borrower specific, and buyer specific. So you can't be playing games with on the 14th, hey, you know what? I have a new buyer. So I need more time.
Nope.
Nope.
Yeah, I had one back in the day where they gave us a short sale approval letter and we needed 2 extra days to close, and then they were gonna give us another approval letter, and in those 2 days, the note got sold to a different,
Right.
servicer, and basically that entire process was over, and then they wanted us to restart
Yep.
the process in that role. So,
I
just to
always
get
would ask,
Uh-huh.
I would always ask, is this loan part of a portfolio? I always would ask, who is the investor? And is this part of a portfolio that is under consideration for sale or not? If you know. And if you don't know, can you find out? And in my case, they would ask. And um, uh, I would, I never, trying to think if I ever had a situation where I got tripped up that way. I generally speaking didn't because I would just ask up front.
What other questions like that would you ask up front? Because that's a great question. And obviously, somebody, I think that was maybe like my third year in the business, not as much experience as we have now. Like, what other questions like that would you say that are important?
I mean, I know this sounds trite, and I keep referring back to the borrower, the property, the transaction, the closing statement. Um, and so You have to, in my opinion, as a broker, work, or as the individual trying to get short sale approval, you need to be nimble in terms of understanding the file. It's not just a matter of throwing. So, what questions, other questions would I ask are really dependent on the totality of everything. You just need, as a broker, to understand that file to know what might affect them. For instance, something you haven't asked and we haven't talked about, I've mentioned it, the cash for keys.
Mhm.
Just about every single file, I would ask, okay, now that we have approval, before that goes to a signed writing, what about cash for keys? And they would say, well, we haven't talked about that. I said, well, I'm asking you now. And generally speaking, I would get a good deal of cash for keys to get the person out, the borrower out. That's taxable to the borrower, to the defaulted borrower, but it's important to them because I can pay their first and last month and security deposit.
Why not
So
include that in the original HUD versus right until that moment of short sale approval?
timing is everything. They don't want to be asked that question. They don't even know that they can approve the file. And you're already asking, you have your hand out for money for the borrower. Doesn't
So
work,
it's better strategically to ask for it more last
in
minute,
my
basically.
opinion. In my opinion.
Got it. Now, all these additional terms that you're negotiating, you said that in the short sale approval letter, it's boilerplate and you don't really change much. Where do all these items get outlined then? Is it in the short sale approval letter or is it somewhere else?
It's just in the short sale approval letter. I mean, the
Okay.
only you have the promissory note that really establishes a contractual arrangement by and
Mm.
between the investor. Let's be clear on terminology. The investor may or may not be the bank
Yeah.
or the
Uh,
servicer. It's probably not. It's usually the investor is somebody else, and it's a REIT somewhere that's been created and has this portfolio of loans that it's put out there. Um, but and then you have the deed of trust, and you have all of the supporting disclosure documents. Remember that thick packet I was talking
Yeah.
about?
Yeah. Hmm.
That's why I want to see that. I'm probably one of the few people doing loss mitigation that would actually take the time to read all of that stuff. And the reason I would OCR it is I was looking for buzzwords to find out whether or not there was a particular provision that I knew was in other files. It was a different lender. And so, I was comparing and contrasting. There's a lot of standardization in the documentation, but uh, different lenders slip in other documents at the time the loan is originated. So, yeah, I would delay the timing of asking for certain other benefits like the catch for keys.
Got it. Okay. Um, we already talked to, so what is a strategic short sale? I know that we talked about earlier, but I don't think that we really got to talking about that. What is that?
A file I would never take. And that's where I knew or had a sense that somebody was just trying to play the system and they really didn't have a hardship. The referred check document that needs to be completed as part of the application
Mhm.
to loss mitigation, that hardship can't be BS. And I would uh, stress test, if you will, the authenticity of the hardship. And if I found that it was something, for instance, I had a guy who got past me and I got him approval or near approval. And the loss mitigator said, "Hey, Paul, we just noticed that your client, our borrower, bought a Porsche." And I said, "Really?" And that threw out this guy's claim to hardship. He didn't have a hardship. He was
He
playing
bought a Porsche in the middle of the short sale.
at the end of the approval process.
That's crazy.
So I fired him. You can't fire me. Okay, you're fired.
That's so funny. Okay. So basically, like somebody not really having a hardship, pretending that they're having hardship. What about fees? Are there any fees to the homeowner in a short sale process?
With a lender, no. With representation, yes. If it's a real estate broker, listing, marketing, and selling the property, it's going to be a standard um, listing agreement. In all cases where I was collaborating with a broker, it would be a 6% commission. 3.5% goes to the listing office, split evenly with me if I'm negotiating the short sale and I'm involved in the transaction
Hmm.
itself, all the documentation. And then with regard to, well, you're only asking a question on fees as it relates to a short sale.
Yeah.
I don't charge on an hourly basis. If you're asking me,
No, the way I was thinking about it, even the real estate commissions, the lender pays for them. So it could be that the homeowner doesn't pay nothing, basically.
there's a lot of litigation out there about who's really paying for the brokerage commission on the selling office.
Yeah.
Back east, and there are several lawsuits filed. Just I think it was last week, not just maybe it was even Monday. But in any event, who really pays for it? It's really the buyer, right? That's where the money's coming from to buy the property. It's just that the lender approves the closing statement before an estimated closing statement before it gives you approval. And then they go back at the end of the transaction when it's closing to compare and contrast the closing statement that led to the short sale approval and the actual closing of the transaction to make sure that they're nearly identical, with the exception of prorations.
if, if you do a short sale, does that affect your ability to buy a home right away?
It typically does for at least 3 years, and it all depends on who that new lender is. That new lender is going to look at you differently than if you had not had that default and that credit ding on your credit report. Um,
Okay.
and of course, obviously, it depends on how much cash you're putting down, equity, what the loan is. Is it jumbo? Is it, so there, again, there are not as many black and white answers as you might hope to be getting from me.
No.
It depends on the property and the borrower 3 years
Got it.
out. But generally speaking, lenders will look at somebody 3 years down the road.
Perfect. Anything else that we might have missed as it relates to short sales?
Just repetitious here. They can be complicated. There's a lot of legal and tax advice being given. You have to be nimble. You need to separate emotions from this is a business decision. And uh, whoever you bring on board, be ready to be transparent with them. Act fast, make informed decisions, and hopefully you'll come out okay.
Mhm. I love it. Cool. And then if somebody wanted, maybe there's a broker out there watching this, or maybe there's somebody going through financial hardship that wants to do a short sale. If somebody wanted to get in touch with you, what would be the best way for them to do that?
They can go to my website, stansen.com, STANSEN.com, and everything that we've talked about is actually on my website. It isn't that this is a secret. The secret sauce to doing short sales effectively on a volume basis is giving the advice that I talked about and being really prompt and transparent with the loss mitigators. So Stansen.com website, or my email is there, Paul at Stansen.com, or 818-512-1715, and they'll get through direct to me.
Perfect. I want to say thank you, Paul, for taking the time to be on the show. To our viewers out there, I want to say thank you as well for taking the time to watch the show. If you guys have enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode would be helpful to a friend, make sure to hit that share button. Paul, once again, for our viewers, we had Paul Stansen. We talked about what is a short sale. We talked about how does short sales work. We talked about short sale application process. We talked about short sale approval letters. We talked about strategic short sales. We talked about whether it affects your credit, just an all-inclusive video on short sales. Once again, Paul, thank you so much. To our viewers, thank you again. And until next time.